Hello traders, you're welcome back to the Forex Geek channel. In this video, we are breaking down an easy to follow gap up and gap down trading strategy that works across Forex, stocks, and indices. Now, market gaps can create some of the best trading opportunities, but if you don't know how to trade them correctly, they can also lead to costly mistakes. All right, so in this video, we'll go step by step through how to identify gap ups and gap downs on your chart, the best strategy for trading these gaps, key entry and exit points to avoid false signals, and common mistakes that traders make when trading gaps. So make sure you watch till the end because I'll be showing you, some examples so you can see how this strategy works in, you know, um, in the forex market. Okay, and before we dive in, don't forget to hit the like button and subscribe to the channel for more trading strategies and technical analysis breakdowns. Let us get started. First things first, what exactly is a gap in the market? Now, a gap happens when the opening price, all right, a gap happens when the opening price of a trading session is significantly higher or lower than the previous close. So in this case, we can see that this was the close price for the previous session, right? We can see that the close price for the previous session was somewhere around here, right? But the open price for the next session was around here. So you can see the difference. There was a significant difference between the closing price of the previous session and the opening price of the next session. So when such a thing happens, we have a gap. You can see this space in between. That is what we call a gap. Creating, that difference creates an empty space on the chart. So a gap up occurs when the price opens higher than the previous close. This is a gap up. This is an example of a gap up. When the price opens higher than the previous close, it's often due to strong buying momentum, overnight news, or earnings report. All right. Then we also have a gap down. Let's see if we can find an example of a gap down, on this chart, since this is USD CHF. Okay, we also had a gap up here. The reason you might be wondering why I went to USD CHF. The reason is that if we had a gap up on the Euro USD, where the USD was the quote currency, then I want to assume that if it was a USD related event that caused this gap up, then we should have a gap down around the same period on a currency pair that has USD as the base currency. So let's just check if that is going to be the case. This should be around the 3rd March, is it? All right, yeah, 3rd March. Okay, let's see what we have here. See if we can find such around 3rd March. 3rd March, 3rd March. Is this 3rd March? Okay, this is 4th. This is 3rd. Okay, yeah, I think we had a gap down here. Can you see that? So I guess I was right after all. See, we had a gap down. So a gap down occurs when the price opens lower than, you can see that this was the close price for the previous session and this was the open price for the next session. So you can see this difference. See, it was a significant difference from the close price and the open price, right? So so a gap down happens when the price opens lower than the previous close, usually because of negative news, market sentiment shifts or weak economic data. Now, these gaps often lead to one of two scenarios. One, the first is a continuation, where the price keeps moving in the direction of the gap. Then the second is a gap fill, where the price retraces back to the previous close before making its next move. All right. So knowing how to determine whether the market will continue or fill the gap is key to making better trading decisions. Now that we understand what gaps are, let us go over how to trade them effectively. Now, this strategy works best on intraday and swing trading time frames. So if you are a short-term trader, pay close attention. All right. The first step is to identify the gap at the market open. You check your chart at the start of the trading session to see if there is a noticeable gap between the previous close and the new opening price. The larger the gap, the more significant the trading opportunity. All right. Then the second step is to determine the type of gap. Now, if the gap occurs with strong volume, if you want to know that, you can just add on a volume indicator and check out the volume around that period, right? Okay, let us see what happened on the EUSD, EUUSD. All right, we didn't exactly have much of a volume though. Yeah, as you can see, there was not really much volume around here. But if there is strong volume, right? If the gap occurs with a strong volume and continues in the same direction, then it's likely a breakout gap. So we'll be looking towards trading in the direction of the move. All right. But if the gap is weak with low volume, then there is a chance of a gap fill, right? Meaning that we trade against the initial move, expecting price to close the gap. You understand? All right. So now, the third step. Okay, what I mean, let me just explain a little bit before I proceed. Now, because we have small volume, had it been we had a spike in volume, we should be looking for buy opportunities immediately after the gap. All right. But because there was low volume, we are expecting a gap fill, meaning we are expecting price to come back down and close that gap. Now, even though that the price did not exactly come to the beginning of the gap, but at least it came down notably. It came down notably till, I think it went maybe around 60% of the gap or thereabouts, maybe between 50 to 60% of the gap was filled, even though it didn't fill the gap completely before bullish momentum set in. But had it been you had picked this trade on time, right? If you had picked the trade on time, and of course, you should look for a sell signal. It doesn't mean that you're just going to jump in and enter your sell because you're trying to get the gap fill. Okay, you must wait for a signal, a confirmation or something. For example, we can see this particular dragonfly gravestone doji. Sorry, we can see this particular gravestone doji. So this would have been a good opportunity to sell. So imagine if you had sold here after this gravestone doji, and then you had remained in that trade, because of course this is going to be a scalping trade, right? So you had remained in that trade and waited for a possible continuation pattern, right? Or you can even go to a smaller time frame, because in this kind of scenario, you can go to a smaller time frame to look for any sign of continuation. So for example, we can see that the gap was filled to about 50 to 60%, and then right after, this is the 15-minute chart, right after this bullish rejection candle, can you see this candle? Right after this candle forms, there have been a better opportunity to exit that your sell trade, in as much as you would have been expecting the gap to be filled completely. But remember that sometimes the market might not always do what you expect. Okay, no strategy is 100% accurate, so you should be looking for a reversal pattern, and after this particular candlestick formed, it would have been a good time to exit your sell. So let's go back to USD CHF. Let's see if we can find okay, now in the case of USD CHF, the gap was filled completely. Can you see? In the case of the USD CHF, you see right after the gap down, the gap was filled completely, immediately. So you can see that the price went up and filled the gap completely. Now, remember that it's not all the time that the gap is going to fill. Even if you want to say that this particular one did not get to this place, you can see this one still went there again and touched this point. before coming down. So in some cases, you might have the gap filled completely. In other cases, it might not get filled completely. So just make sure you always watch out for reversal patterns or continuation patterns. Okay, so do not just assume that the gaps is going to get filled always, all the time. All right, do not just assume that. Okay, so basically that is it, right? Ensure that you always use stop losses, okay, and use good risk to reward ratio even after you enter the trade. Set your stop loss appropriately. All right, you can set your stop loss if it is for the case of a buy, right? After you enter, okay, this is sorry, uh, this was a gap up. All right, so this is gonna be the case of a sell. Set your stop loss above the swing high. Then in the case of a buy, you set your stop loss below the swing low. All right. Then you aim for a good risk to reward ratio of at least 1 to 2. If you're risking $1, your potential profit should be at least $2. But that doesn't mean that you shouldn't be watching out for possible reversal candlestick pattern. Give more priority to what the market is saying. Okay, give more priority to that over your risk to reward ratio. Okay, because this is basically a scalping technique. So of course, because we are looking at perhaps the first few hours of the first few hours following the gap, right? So just watch out for reversal candlestick patterns, okay, and then set your stop loss appropriately and ensure that you take your profits as soon as possible, as soon as you notice any possible reversal. All right, now if the price continues in the direction of the gap, let the trade run. All right, for example, if we had high volume and you notice that the gap continues, like the price continues moving in the direction of the gap, then just let your trade run. All right, you can enter a trade, allow it to run. You can be trailing your stop losses instead. But if the price starts filling the gap, consider closing the trade early or trailing your stop loss. Now, before you start trading gaps, here are some common mistakes you need to avoid. The first is blindly trading every gap. Now, not all gaps are worth trading. Always check for volume and confirmation before entering, okay? And secondly, do not make the mistake of ignoring market conditions. If the overall market is in a strong uptrend, a gap down might be a trap rather than a true bearish signal. All right, and always use tight stop losses. Sorry, do not always use tight stop losses because gaps can lead to high volatility. So give your trade some room to breathe. If you are trading gaps, do not make the mistake of using tight stop losses. Okay, if you're entering a sell trade, give some space for your stop loss. All right, your stop loss shouldn't just be at the just immediately above the gap. Please give some breathing space. All right, remember that this is a scalping strategy because you are targeting just the first few hours after the gap. So you might not really stay in the trade for too long. So ensure that you give the market some breathing space and ensure that you are timely in exiting your trade. All right, and do not forget to check news and events because economic data releases and earnings reports can cause gaps. So always check the news before taking a trade. Okay, so that is it, traders. Gap up and gap down trading can be a powerful strategy when executed correctly. Whether you are trading forex, stocks, or indices, understanding how gaps work can help you take advantage of some of the best trading opportunities. All right, if you found this video helpful, make sure to hit that like button and subscribe to the channel for more in-depth trading strategies and technical analysis tutorials. Let me know in the comments what topic you would like me to cover next. Okay, thank you for watching and I'll see you in the next one. Happy trading.